QuickBooks Pro Plus Desktop 2022 OneNote Presentation. Advanced Customer Payment or Unearned Revenue Method Number 2. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introduction, 8200, Advanced Customer Payment or Unearned Revenue Method Number 2. Also take a look at the Immersive Reader Tool, topic introductions in the text area 2, same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're focusing in on the home page and looking at the advanced payment once again. Last time we looked at method number 1. This time we're going to be looking at method number 2. The advanced payments being a situation where we're getting paid before we did the work, and that's unusual because normally, as you can see with the flow chart here, normally we do the work first and then get paid, or we do the work and get paid at the same point in time. Here we're imagining a situation which would typically be driven by the type of industry that we are in. We're getting paid first. Last time we recorded it just with a received payment, which works logistically quite well, but is not quite right when you first record the transaction. It'll just be a timing difference after you create the invoice, but it's not quite right when you record the transaction. You might say, well, is there a way that we can basically record it so that I'm not recording a negative receivable, but rather recording it to unearned revenue at the point in time we record the transaction? So that's what we'll go into at this point. What we would like to see from just a journal entry standpoint when we enter the advanced payment would be that we have an increase of the unearned revenue, and the other side is then going to a liability of undeposited funds as opposed to a negative accounts receivable account. So if we go to the customer balance detail, this is the balance detail related to the accounts receivable, which is kind of the problem because you kind of like to see the detail that's going to be recorded in here, which is more difficult to do if you're setting up a liability account for a customer, because this subledger is tied to the accounts receivable subledger. So we're going to go to the sales receipt again, just like we did last time, but I'm going to create a new item. I'm sorry, this is not like we did last time. We're going to a sales receipt as opposed to a received payment form. This is the form normally used at like a cash register, and you're recording the payment at the same point in time. But then we're going to create a new item up here. I'm just going to call it a customer deposit item, and it's going to go to another account, which is going to go to unearned revenue, which is a liability account and not a revenue account. So we're recording like it would be a sale that's taking place, but we're kind of tricking the system that we're not recording it to a revenue item, but instead we're going to be recording it to a other current liability item. So here we have it. So here we have the sales receipt, which normally would be increasing the undeposited funds. It's still going to be doing that, but the other side would normally go to sales, but we kind of tricked it because we used an item that's recording it. Instead of going to sales, it's going to the unearned revenue, which is where we want it to go. So if we go to the trial balance, we can see here that we have the unearned revenue has now gone up by the 100. That's what we want. The other side going to the undeposited funds. So instead of having a negative receivable, it went into the undeposited funds the way we want it to. So if we go up to the accounts receivable, there was no impact on the accounts receivable. If I go into the string music in the customer center, then I see it here and it looks good, but it's kind of deceiving because it looks like a sales receipt, which would mean that you would think that the other side would have gone to revenue because that's what a sales receipt typically does, but it's not. This 100's going to the undeposited funds. What we expect to happen later is that we're going to receive the payment on it, and it'll kind of net out against that $100 when we record the invoice. If I look at the customer subledger for string music, then it's not going to be on the subledger because these are showing invoices and outstanding payments. So it's going to be like exempt or not on that form, whereas the last method, it would be showing in that form as basically a payment. Now let's create an invoice. We're going to make an invoice now, and we're going to say that we're selling an EPSP to string music, and there's the amount. Now, instead of us going up top and being able to apply the credit as we did last time, because remember the credit isn't in the same kind of lineup, it's not related to the subledger, we got to then use our item that we set up, which is the customer deposit, and then record the negative 100, which will take the balance down to the 500, and then apply basically the sales tax to it. So this will net it out, but notice it looks a little bit different than what we were expecting to look like in the original kind of method. I kind of think the original way we did it looks more proper in terms of the actual invoice and the way that it's going to be applied out to the actual invoice. In other words, I kind of like the format where it showed the invoice and then the credit basically at the bottom. I think that's a more clear kind of message or invoice that you would be giving basically to a customer. So I don't think, like, logistically, the look of it is quite as good, and the link isn't quite as good because you have to memorize the fact that this amount was in undeposited funds for that particular customer, which isn't quite as easy to track as well, and you can't just apply out the credit in the same kind of way. So it's a little bit more tedious in that way as well, but it records more properly on an accrual basis, which is more what you would think would be happening if you just did this with basically debits and credit format. So what's this going to do? It's going to be increasing accounts receivable by the full amount of the 530. The sales is going to go up by the 600, and then you're going to have an impact on the unearned revenue, it going back down by the 100. Notice the deposit portion here is a non-taxable item, and then you're going to have the sales tax payable, which is going to go up by the 30. The inventory is going to be going down by an amount not on this invoice, but driven by the item of the EPSP, the Epiphone Standard Pro, and the cost of goods sold is going to be going up as well. So if I look at the trial balance, the accounts affected are the accounts receivable, and then the sales are going to be at the bottom, the sales tax payable, and then the inventory, as well as the cost of goods sold, which would be down here, and the undeposited funds then, I'm sorry, not the undeposited funds, the unearned revenue went down to 0. So we got that key other component. Here is the undeposited funds. It went up by the $100 for the sales receipt, which is really an advance payment. And then the invoice brought it back down because we added that line item into the invoice. So if we went to the detail for the customer balance detail, we wouldn't have any detail related to the $100 because we didn't record it with a payment. So this, again, to me, looks a little bit funny because we got the invoice here, which does include, if you go into the invoice, that we have that line item that decreases it by the $100. But to me, it would look better here, the prior method, where you have the full amount of the invoice and then you see the payment separately, and then you kind of match those two together. So it's not perfect logistically. To me, I think the prior method is better logistically, but it does record more on an accrual basis, more properly throughout the process. And then we're going to scroll down to the customer information. So here we are in string music. Once again, we got the sales receipt of the $100 and then the invoice here of the 530. So you can kind of see the detail, but to me, again, I don't think it's quite as clear as just payment matching out the payment to the invoice is in the prior method from a logistical kind of standpoint. So here we have the customer information for Anderson guitars in the prior method. You'll note the invoice here was put on place for the full amount. We didn't decrease it by the prepayment, even though the prepayment was at the bottom of the invoice so that the customer can see it. It wasn't actually in the calculation of the invoice. And then we've got the payment that kind of nets out, and we see that relationship is just the same as it always would be, except the payment happened before the invoice. So this is a lot cleaner, I think, from just an accounting standpoint to look at than this up top. I think this is a little bit more ugly because now we got the invoice on there that is net, and we had to then figure out that we had to take that negative amount and create a new item and track the item in a separate account in order to apply it out. And the sales receipt isn't really a sales receipt because it's actually a prepayment. So I think this is a lot more difficult to kind of look at just from an internal logistic type of purpose. That's why I tend to lean more, even though this method would be one that kind of works well from just a journal entry standpoint, I kind of think that from an internal purpose, the accountants in any company might like the look and feel of this better, and then just do adjusting entries at the end of the year and at the end of the month. But again, either method could be applied. So if we did this one would look more straightforward just from a journal entry standpoint. So it would just simply be, we would have the undeposited funds going up by the $100 and then the unearned revenue when we get the payment. This is what you would expect to see from just a journal entry standpoint in a book problem. we'd have unearned revenue or cash basically going up by 100. And then instead of decreasing the accounts receivable here, we would have the unearned revenue, a liability account, which looks great from an accrual standpoint, but is a little bit more difficult from a logistical standpoint in the software because of the subledgers. So then we've got the unearned revenue was at 0, goes up by 100 to 100. I'm sorry, the undeposited funds, these look similar. And then the unearned revenue went up to 100. And then if we look at the detail here, we've got then the invoice that's going to be created after this. The invoice increases by $600. And then we've got the sales tax, which is going to be 5% of it. And then we have the $100 that had already been paid to us. So we're going to decrease the unearned revenue back down by the 100, which means we're only going to get $530 in the accounts receivable that's still due to us. And then the cost of goods sold and the inventory are impacted. So now we're saying accounts receivable is going up by the net amount that is going to be due when we issue the invoice, and the same impact on the year to date and the February numbers. The inventory is going to be going down by the same amount for the February numbers and the year to date because they're balance sheet numbers. The sales tax payable is going up by the same amount for February and year to date balance sheet numbers. The sales was at $10,474 for the month of February, goes up by 600 credits to $11,774 for the month of February. For the year to date, it was at $57,351, goes up by 600 to $57,951 for the year to date. The cost of goods sold was at $7,832 for the current month, goes up by $480 to $8,312. The year to date was at $45,744, goes up by $480 to $45,554. And the current month in terms of the net income was at $2,296, goes up by the net of the 600 minus the 480, the 122, 2,416. Year to date was at 9,724, goes up by the 120 to 9,844 on the net income. Here's the accounts receivable. It went up from 20,426 by the 530 to the 20,956. Notice there's no impact from the $100 prepayment in accounts receivable in this method. And then over here, we've got the undeposited funds goes up by the 100. That's basically the cash. And then the sales tax payable goes up by the 30 to the 2,898. We got the sales went up by 600 to the 57,951. Cost of goods sold goes up by 480 to 45,554. Inventory goes down by the 480 to the 4746. And the inventory subledger, then one of the items we sold, at least I think this was the only one, was this EPSP. We had 4 of them before. We sold 1. Now we got 3 times the 480 gives us the 1,440. If we add up all of the inventory items, they add up to the 4,746, which should match up to the general ledger and the trial balance as well as the financial statements.